Hello, I'm Nicholas Hyatt, Investment Manager here at Wealth Club, and today I'm with Peter Dines of Mercia Ventures to talk about the Northern VCTs. For those who aren't familiar, would you mind giving us a bit of background about Mercia Ventures and yourself?
Sure. So Mercia Ventures, we're one of the most active seed and Series A investors in the UK. We've got a national footprint of offices and with a large investment team that are based in our offices from London, Bristol, all the way up to Newcastle. And our focus really is on building strong, lasting relationships with our founders and also supporting them in any way we can.
And how about the Northern VCTs? What do they aim to do for investors?
So we aim to build a diversified portfolio across 4 sectors. So we invest in health technology, in software, in consumer-facing businesses, and also in IP-rich businesses, often called deep tech. We also aim to be diversified in terms of asset size as well. So no asset is greater than 4% in terms of the net asset value of the fund.
So within those sort of core sectors, what are you looking for in companies, and what do you look to avoid?
I think the key thing is alignment with founders. So across each of the sectors, we have a specialist team who understand each of those markets and sectors. But the key for any investment is the founders and the management teams, and ensuring that we're aligned in terms of their vision and their expectations in terms of returns. I suppose the opposite is actually if we can't find alignment, that's often where we unfortunately choose not to invest.
So have you got any recent examples of companies that fit that kind of founder-led focus that you're after?
Yeah, sure. I can give a few examples. So the most recent investment we've done is a company called RiskLedger. They're an interesting cyber security business, and obviously cyber security is a big risk for every business nowadays. But what they're doing is actually looking at the supply chain. So there was a case recently where the BBC were caught by their payroll provider having a cyber issue. So RiskLedger are focused on how a company can look all the way through their supply chain and make sure they're protected. Another example on the life sciences side would be Camina. That's a Cambridge-based business where they're developing new synthetic genes. So they're focused on the big pharma companies to improve the supply chain for pharmaceutical companies.
And what about the existing holdings, the ones that are perhaps a bit larger within the portfolio? Any highlights there you'd like to talk about?
Yeah, there's a number. Current Body is a consumer-facing business. We partially exited that business a couple of years ago, but they continue to go from strength to strength. Their sales are now well over 100 million. They were even featured in their beauty mask in a Netflix series. So that's one that's going very well. Gentronics is a toxicology CRO business. They are growing both sales and profit. And then Climbing Hanger would be another one. So they're an indoor bouldering and climbing centre business, continuing to roll out new sites, with Reading being the most recent one and filling capacity the quickest they've ever done. So a number of interesting businesses and fast-growing businesses within the portfolio.
You mentioned earlier that you're working alongside founders to do more than just funding. What does that look like in practice?
Yeah, so we typically take a seat on the board, a director and an observer seat. But more importantly, because of our scale, we've got a breadth of experience that we can call on across the whole of the Mercia Ventures team. And we've also developed something that we call Nucleus. So that's our value-add platform that we provide. So that would include things like talent acquisition, so building out the boards, adding in experts who maybe really know the sector or the problem that a company is facing, as well as knowledge sharing and having events for any of the C-suite so they can actually share knowledge from each other as well. And that's proving to be really valuable for our founders.
So the investment environment has changed a lot recently with higher interest rates. Has that sort of added extra been more useful in that environment? And are you seeing any opportunities or perhaps headwinds from that change in economic backdrop?
Yeah, it's been an interesting few years post-COVID with various macro issues, not least the one you mentioned. I think the main thing that we're seeing is follow-on funding, especially in the US, has slowed down. So our advice with all of our portfolio companies is, A, how do you extend your runway? So that is maybe around cost cutting and ensuring that they can extend the runway. as well as building relationships with those other funders, understanding what they're looking for, and then we work with our companies to make sure that they have the right metrics to then be successful in later years. From an opportunity perspective, the valuations have softened slightly in terms of entry valuations, which is a positive.
Of course, it's risky investing in early stage businesses. What sort of percentage of companies do you think are likely to fail?
Yeah, so I'm pleased to say absolute failure rate is very low. You're right, it's not without risk. But what we also have is we've invested in a portfolio team, so that those are individuals who have got lots of experience in terms of the venture market. And from our perspective, we don't cut and run. What we like to do is work with the companies, even when it's maybe not going exactly to plan, to get a return rather than necessarily the return we initially thought. So that tends to be our style, and that's worked out well, certainly in the last few years, and we plan to continue to do that approach.
And on a more positive note, any exits you've had recently that you could tell us about?
Yeah, we've had a good run of exits in recent years. So our most recent exit was Evotix, which was our number one holding in the portfolio. They were a fast-growing health and safety software business where we exited for a headline value of 125 million. That was a 4.6 times return for the Northern VCT shareholders. And interestingly, the CEO of that business is now the CEO of the combined group. So the acquirer saw the strength of our management team, and Matthew in particular, and so he's now running that combined group. So and overall, we've had over the last 2 years 14 full or partial exits and generated over 150 million. So that's a trend that we're working hard to continue.
That sounds like the performance of the VCTs as a whole might have been pretty positive recently then.
Yeah, so certainly looking at the last 5 years, where it does include COVID and other macro elements, there are 3 VCTs within the Northern VCTs, and the total return has been between 26% and 28% over the last 5 years.
Dividends-wise, what do the VCTs target?
So each VCT has a separate board. So MVT and N2 target 5%, and N3 target 4.5%, but at a higher net asset value. And certainly over the recent years, they've exceeded those targets, including a special dividend in 2021.
So Peter, to sum up, if I wanted to invest in a VCT this year, why should it be the Northern VCTs?
So for investors looking for a diversified portfolio across a number of different sector areas, with specialist teams who have a national footprint, then I would say Northern VCTs are the fund.
Peter Dines of Mercia Ventures, thank you very much. If you're watching on YouTube, please press like and subscribe to the channel for more.